Welcome to the Wealth with Notes podcast. I'm Sierra Davis, a private fund manager and asset manager in the note investing space, and wife, a mom, born and raised in Kansas City. And this show is about one thing: building wealth through private financing and note investing. The real mechanics, the real deals, the real story behind what it looks like to be the bank instead of the borrower. Some episodes it's just going to be me. In some episodes, I bring in people who are operating in this space and are generous enough to pull back the curtain on what it actually took. Either way, you're going to walk away with something you can actually use. Let's go. Just really quick before we dive in, just wanted to share that tonight is educational and it's based on our personal experiences and what we learned. We're not financial advisors. We're not attorneys or anything like that. And, just always do your due diligence and work with a licensed professional before making any investment decisions. And just kind of here to talk about this as in an educational way. And so we're going to dive into the host tonight. And so I'm Sierra Davis, and I'll let Sequana share a little bit more about her background. But I run an essential investment group here out of Kansas City, Missouri. I have a background in data analytics and data science. I have an MBA and graduated with a lot of debt and student loan debt. I try to figure out how to get out of that debt. Had really good income, 6 figures, but really try to figure out, okay, well, there has to be something else out there. And so I decided to look at things a little bit differently and found about note investing and things like that. And so I want to share a little bit more about that, and I'll talk a little bit more about that as well. But right now, it's kind of focusing on building my portfolio. I was able to leave my W-2 last April, so it's almost been a year now, but just kind of focusing on how that passive income can build and cover life's expenses, not someday, but today. And so it's really exciting to kind of have that experience. And I'll let Sequana kind of tell her story as well.
Okay, good evening, everybody. So yes, like Sarah said, I've been working with her for the last few years, and I'm excited to be here with you guys tonight. So you're definitely going to want to take notes. We have some really exciting stuff to share. I think it's going to be really informative and educational for everybody. So for my bio, I right out of college, I worked with the Department of Agriculture for 23 years. That was my career. I rose to deputy director of my division along the way, but I always knew that wasn't where I was going to retire. I didn't have a desire to retire there. I really wanted the flexibility to be able to, own my own time. That's what people talk about, financial freedom. I have a 6-year-old son. I want to be available for everything that comes along the way as he grows. So I got introduced what we're going to share with you tonight. And this strategy helped me to create over $15,000 in passive income within 2.5 years. That was more income than me and my husband were bringing in alone through our job. So I actually ended up leaving my job with the government. I'm going to, share all about that with you tonight. Let's just talk about, the old playbook being broken. So I want to ask you something. How many of you were taught this formula? Go to school, get a job, contribute to your 401k, work 40 years, retire at 65 if you're lucky. That was the plan. But here's the truth. That plan was built for 1985, not 2025. The world's changed. The economy's changed. Life expectancy has changed. But retirement advice, that's still the same. And that's the problem. So there's record household debt, record credit card balances. Most Americans can't cover a $400 emergency. So when someone says just invest more, with what money, right? That's generally what people are asking. Okay, what money am I investing more with? And people aren't lazy. They're squeezed. We're working harder than ever and you still feel behind. So, here's the trap. You work to pay bills. Debt keeps you stuck. Saving feels impossible, and then retirement feels theoretical, right? So it's not a discipline issue. That's a system that's not working, and you know it because you feel it, right? So inflation it's a silent theft, right? Inflation, it doesn't ask permission. What cost $1,000 20 years ago, that now costs $1,800. groceries, insurance, rent, everything. And your savings account, you might be getting, I don't know, 0.1%, 0.2%. And that's not growth, that's decay. And here's what's dangerous: inflation compounds quietly. So if you retire and you live 25 years, your expenses, they won't stay flat. If your income does, then you lose. You don't need a pile of money. You need income that moves. So this is something that people, I don't think, are thinking a lot about now either. Though we're living longer than ever. So and that sounds like good news until you realize that that's 20 to 30 years of income you must produce. So Social Security, we all know that was never meant to fund your life, right? That it was meant to be to supplement it. So if your strategy is, okay, I'm gonna save a big pile and I'm gonna withdraw from it, what happens when that pile starts to shrink faster than you expected? Right? Retirement, it isn't about stopping work, it's about replacing income. And most people were never shown how to do that. I mean, especially in the traditional sense. So the real question, let's be honest, 401ks, we know they're market dependent. The FIRE movement, that's extreme sacrifice, but that's still market dependent. Stocks, those are volatile, when you need them the most. So the real question is, what if your investments cover your bills right now? Not someday, not at 65. What if your mortgage was handled? Your groceries were handled, car payment was handled. That changes everything. And that's where we pivot. And that's why I want to throw it to Sierra to tell us all about mortgage notes.
Thank you for showing us the problem. So basically the traditional strategies are broken. And it's one of the strategies that helped me get along the path to replacing my income. And so I want to tell you specifically why I chose this strategy. I want to be honest with you. I looked at a lot of options before I landed here: fix and flips, buy and hold, rentals, wholesaling. And I spent 7 months basically going through different strategies before I found this one. And these are the three things that stopped me from looking further. And so one of the first ones was location freedom. I was able to decide if I wanted to trade my desk in for another one, maybe not, but I can do everything from my MacBook anywhere in the world. That's exactly what Notes gave me. And the second was, after a note is purchased and handed off to a servicer, the ongoing work is generally just a few hours a week reviewing numbers and checking in on paperwork. The borrower owns the property, which we'll definitely talk about that a little bit more. And they deal with the maintenance. And so that was fundamentally different than what the traditional things were as far as rentals and fix and flips, right? I had to go in and be doing the work physically. That was one of the things that kind of set it apart. And the third one is that I come from an analytical background. And so I get really excited about cash flow math. I was able to use some of the skills from corporate to translate into investing. The current markets and all of these things produce almost roughly 2 times more the cash flow than a comparable rental property, because you don't have all the expenses. We can talk about that a little bit more of a traditional rental property. I know many of you have bought a property or live in a residence where you've bought something from and you've used the bank to finance it. And so I wanted to share with you how the concept is not so far away than most people think. When you buy a house without using all of your cash, you typically go to the bank. And so when somebody buys a property, any property, they sit down at the closing table and they sign 2 documents. It's a promissory note, and that's basically something that says, it's a promise, a legal binding document that promises to say, hey, I, the borrower, will pay the specific amount every month, every single month for this many years at this interest rate. And it doesn't say I'll pay this when the market is good. I'll pay it when my situation is comfortable. It just says I will pay this every month. That's the contract. And the second document that you could sign is basically called a security instrument, whether it's a deed of trust or a mortgage, depending on the state. And what that does is tie the promise to pay to a physical piece of real estate. So if the borrower ever breaks their promise, if they stop making those payments, the lender has the legal right to take the property back. The real estate is what backs that promise, and it's the protection. So you have a contracted promise to pay as well as a physical asset securing that promise. And that's the whole foundation. Here's like the part that surprises most people is that banks don't hold on to these notes. They originate them, they set them up, and then they sell them. I don't know how many times if you have a property that you close on a deal on a property, and then next thing you know, you're playing chase, and then you pay somebody else. Well, that is a sure sign that somebody has transferred that note, and so they do it all the time. That's a business model. So they're not waiting 30 years to collect their payments. Nothing's changed for you. Nothing has changed. It's the same payment. It's the same interest rate. It's the same terms. And the only thing that changes is who receives that check. And so here's a question. The company that bought your loan, what did they actually do to earn that payment? They did not build the house. They simply bought the rights to receive your payments. And I like to tell people all the time is that when you pay Chase, Chase does not care what color your cabinets are. Chase is not going to say, hey, is your toilet fixed? How can I help you? That's the mindset of becoming the bank, is that you are out of the position of making sure that this property is maintained, because that is the homeowner's responsibility. We think about the time value of money. Money today is probably worth more today than it is 30 years from now. We just looked at the chart from inflation. Inflation continues to rise. The dollar seems to go down in value. So if I want to get more money on my investment today, I might want to sell that today in that promise to pay. And so that's kind of why people in banks will sell notes. The good thing about it is that we think about residential properties, we think about notes. There's notes on pretty much everything. And if you're not into single family, if you're only into land or mobile homes, there's notes literally on anything. And so this might surprise you. There's single family homes, commercial properties, land, mobile homes, businesses, storage facilities, anything that was ever financed probably has a note attached to it. And all of those notes can be bought, held, or collected on. So I want to make this practical for everyone sitting here. If you are already a landlord and you've been grinding through like the rental experience, dealing with vacancies, the repairs, property management headaches, basically think about that same down payment, like I mentioned, you would be put in the next rental. You can often buy a note that generates more cash flow per month than the rental itself, without the management, without the maintenance costs. You're going to get actual math in that shortly. If you're into land flipping, I love telling land flippers, hey, go create a note, because this increases your buyer pool. You have a note, you could either sell it for a profit, or you can hold the note. But you could get paid with a down payment, then you can get paid with the monthly payments, and then you get paid again once you sell it. If you're in commercial real estate or multifamily, we see a lot of the time where these non-performing notes, which I'll talk about a little bit more, can be a path for acquiring assets at significant discount without having to compete with 30 other buyers. Why not look at non-performing loans, get a property that way? And so when you buy a performing note, you're basically stepping right into the cash flow stream that is already running. And that moment your deal closes the next month, guess what happens? You begin to receive those payments. There's no waiting for appreciation. There's no vacancy. There's no rehab to get through first. It literally, okay, well, switches over and the payments now go to you after you've signed up with your servicer. And non-performing notes tell a bit of a different story. And so something might have changed for the borrower somewhere along the line. There's a lot of things happening. And so they have a job loss, a health crisis, divorce. Basically, their payments have stopped. And so they're delinquent. They haven't been paying in 90 days or more. And because of that uncertainty, they trade at a much deeper discount. So you might pay $25,000 for a note where a borrower still owes $50,000 on their property. Now, that's really good upside. But the trade-off is that you're now going through a resolution situation. You are either going to work with the borrower to get them back on track, or continue to do foreclosures. But the first thing that you want to do is make sure that you focus on the borrower and where they are, modifying the loan or getting back to where they can pay something. And both of these paths can be profitable, but they both take time, different legal costs, and emotional bandwidth. And so really kind of thinking through these two paths. What are you optimizing for? Are you optimizing for cash flow? Are you optimizing for, bigger returns? No path is wrong. But first, we're going to talk about the performing note side, because that's the system that runs on that predictability, the contracted payments. And really quick, kind of show you like a real deal example here. This property is worth $100,000. The borrower owes about $50,000, which means that they have an unpaid principal balance of $50,000. They have an interest rate of 9.5%, which means the monthly payment is about $420. And the borrower has been making that payment consistently for a year. And so now I'm not going to buy the property. I'm buying the note, the promise to pay, and the right to receive that $424 per month. And because the seller needs liquidity now, so they need the capital now, rather than waiting for many more years payments to accumulate, they're willing to sell the note at a discount. I pay $42,500 for a note where the borrower still owes $50,000. So I pay $25 to my servicer, and that's the company that handles all the borrower communication, collects the proper payments, keeps the records, sends notices if needed. And for $25 a month, I never have to speak to the borrower. I never have to think about the property other than the valuation, which we could talk about. But I just, check the account. And my net every month here is $395. And that's $4,470 a year. I paid $42,500 for a note on a property that's worth $100,000, which basically means my investment to value is about 42.5%. So for every dollar I have in this deal, I have $100,000 securing my position. We can't stress enough today is always do your due diligence when you're investing in anything, because that due diligence will help you on the way if something was to happen. And so we look at the payment history, we look at the property. We might not be buying the property, but if something happens, if we have to take the property back, will we be able to sell it? Will, what will happen? And so that's really a thing that we should be looking at as well. And the paperwork, good paperwork sells. And so if the paperwork isn't really good, if it's not enforceable and the judge kind of throws out our paperwork because it wasn't good, then that's a problem. One of the things that I get asked all the time is, okay, this is great. Where the heck are these notes? So the first place that I like to tell people is, a lot of people, if you go to these meetups, real estate meetups that are doing seller finance deals, that you probably don't know. There are platforms out there as well where you can look at online marketplaces, and you can find these notes. They're pretty much everywhere. So as we start to look at being an investor, there's so many places that you can find these different communities, online communities as well. And one of the things that I like to tell people, you don't have to always buy the full note. If a investor is looking to do a deal for $30,000, then maybe the borrower owes $100,000. They might be willing to sell you a partial of that note. So there's so many ways to invest, and that's why I love this vehicle, especially for this strategies, because there's so many ways to invest, whether it's the asset type, whether it's the structure type, whether it's the timeline type. You can create your own diversification of itself within your portfolios.
So, and now we're going to shift from, the problem. We just learned about the notes. Now we're going to talk about the system. So this is not random investing, the income snowball. This is a mathematical system called the income snowball. This system, it was patented in 2024 after 6 years of research. This is something that I started using, like this income snowball method, in 2021, right? So this is how I was able to get the income that I needed to be able to leave my full-time job. So the income snowball, it forecasts your personal financial freedom date. It's not generic, it's your date. So what we do is we'll plug your numbers in, your income, your expenses, your cash flow, and it shows you when work becomes optional. Like the average person with about $1,000 to $2,500 in extra cash flow, 5 to 10 years. That's how long it takes. Not 40, 5 to 10. And it's not aggressive either. It's just structured. So, most people, they invest and then wait. We invest and then stack, right? So one note produces income. Sierra just told you about, how to find that note. So that produces income. Then that income pays down leverage that frees capital up faster, which buys the next note faster. So each cycle speeds up, get you that momentum. So that's the key word. Momentum beats motivation every time. So I'm going to show you more of an example with real numbers as we go through. So let's say you start with $2,500 in extra cash flow. Not, 50,000. Not, you don't need a lump sum. You're starting with 2,500 extra cash flow. After all your expenses are paid, your income comes in, expenses are paid, you have $2,500 left over. Maybe this is money that you were either saving, spending, or using to pay down debt. So you have $2,500 in extra cash flow, and then you have a $10,000 line of credit. So then you're going to buy note one. That's going to produce about $320 per month in income. So now your total firepower at this point is $2,820 per month. That line of credit is gone in about 3.5 months. And now you do it again. So now you have two notes. That's $640 per month. Then you have three notes. That's $960 a month. And then you have four notes. That's $1,280. So by month 10, you're halfway to replacing your original cash flow just from notes. So this is when people, start leaning forward a little bit, right? Because now it's real. Like, again, it's not theoretical. $2,500 just brought you all these notes just by doing it in a systematic method and stack.
Quick pause. I want to tell you about something I personally use. TARDIS is a wealth coaching program that helped me build a specific plan to make work optional. And I'm still on that plan to this day. The best part, I don't have to sit here and explain every detail of how it works. Their wealth coaches do that for you. All you have to do is schedule a free strategy session, and they'll help you figure out the exact year you can make work optional. If that sounds great, click the link in the description and schedule your session today.